There is an arms race to decarbonize. McKinsey puts the size of this capital flow at about $250 trillion between now and 2050. How you are invested and how you have been invested is not necessarily going to work in the future. So what got you here might not get you there. This is a once in a 200-year opportunity. This new asset class is a combination of literally a new asset as well as a trend that is bigger than any macro mega trend that we've seen to date. Regardless of your politics, regardless of your views on climate, on ESG, we are decarbonizing the global economy. The commitments are made, the money is in flow, and we are seeing the largest capital cycle in history. McKinsey puts the size of this capital flow at about $250 trillion between now and 2050, and about $130 trillion of that will be shifted towards the energy revolution. And we need to position portfolios to monetize that capital flow. It's that simple. This is not about what we would like to happen. This is about what is actually happening. At Kraneshares, we take a very clear view on how investors should be thinking about this transition. We actually don't spend a lot of time talking about ESG. We don't even spend that much time talking about impact. We focus purely on the investment thesis, and we think that's what investors are really interested in. The real capital moves towards real solutions with real economic return. There's going to be carrot and stick. The carrot is going to be the spending. Global governments, China's spent over $500 billion last year. Inflation Reduction Act, $360 billion to be spent in the coming years. Europe has pledged about $300 billion. There is an arms race to decarbonize, and whoever owns that technology will be the most competitive economy in the world. So we are going through this, and whether we like it or not, it's happening. And so we need to position for that. So the carrot, you want to be long the companies and the commodities that will receive those flows. And on the stick side, you want to be long the carbon markets, as they will be the lever the governments use in order to catalyze and incentivize that decarbonization process. This is government policy, compliance carbon markets. Europe, California, the UK, the northeast of the US, and various other markets that are emerging are focused on creating a global price of carbon that will force and catalyze companies to innovate away from their dirty processes towards their clean processes. And so you're going to get a whole revaluation of the economy as that happens, but we can actually be long the compliance market, and that is the new asset class I'm talking about. This is a really critical time for investors to think about this. This isn't a choice to whether or not you want to think about carbon markets, whether you want to have some climate or impact type investments in your portfolio. Because this is happening, your portfolio inherently is short this story. You're short carbon. So you need this in your portfolio in order to either neutralize the inherent short that you might have, or at least participate in what I think is probably the most exciting story of the next 5 years, which is being long the compliance carbon markets. As they tighten regulation, as we are on this one single tightening cycle, you need to be concerned and need to be in this market, at least to manage your risk to it. I ultimately think you should be long this asset class because of the opportunity that it creates. We are right in the early stages of this development. Over $300 billion is earmarked in the Inflation Reduction Act, and most analysts think that number will rise. What we're seeing is this massive acceleration, and as we all know, the way the market's price is we look forward to what we think the future value is going to be, and we discount back to today. So because all of this capital is beginning to move now, carbon markets are at this critical point where both Europe and California, which are two of the biggest markets, are at this inflection point where supply of allowances versus the emissions in those economies is now flipped, that there are not enough being auctioned for the pollution. We're getting price discovery in those markets. So all of the catalysts are coming together, and it's going to be the next few years where the market prices in all of these moves, and we need to be positioned for that. we're entering potentially an era of lower growth, higher rates. The paradigm shifted, and we're seeing a lot of folks looking for where they can diversify and where they can get growth. And when we think about this transition, it is clearly going to give tailwinds to certain parts of the economy, certain commodities, and very clearly to this carbon asset class. And so we want to be positioned in those areas that are going to have this strategic, structural, long-term growth, even in a declining economy. So where can we find growth stories, but also diversification? And that's where this carbon market really comes into play, because our global basket of compliance carbon has about a 0.3 correlation to equity. So we have seen a lot of investors, mainly on the institutional side, gravitating towards compliance carbon. And this is an asset class that has not yet trickled down to the wider masses, to the general retail and intermediary market. We're seeing the institutions, the ultra high net worth family offices gravitating towards these carbon markets. And that's why I think investors want to be aware of this, because this is where the smart money is moving. And the smart money is doing that because A, you've got this structural upside that might be absent in the traditional asset classes. You've got this massive correlation benefit by adding it to your portfolios. And then, of course, you've got this, which I barely mentioned, the fact that this is massively related to impact. Carbon markets are the most powerful tool available to global governments to engineer down and reach their climate targets by reducing emissions. So huge impact, huge potential upside, and huge diversification benefits. Within the overall global transition, global energy transition that we're seeing develop, and we're right at the beginning of it, there are simply three clear pillars that we identify that investors need to either risk manage against or get long those markets. And we see those simply as long compliance carbon markets, long transition equities, and long the right natural resources. This is carbon allowances issued by the four major governments in this market. That is the European Union, that is the UK, that is the state of California, which is partnered up with the various provinces of Canada, and that is what's called RGGI, which is the Regional Greenhouse Gas Initiative, which is the northeast of the US, Virginia through Maine. What these programs are the capping of emissions within those economies and the auctioning of permits. Now, what that does is it doesn't force companies to stop polluting, simply internalizes the value. So if you think about how companies have always optimized their costs, they've always optimized around tax, they've always optimized around the coal that they need to burn, the steel that they need to use, but they've never optimized around the tons of carbon dioxide they put into the atmosphere. So by putting a price on carbon, you start to make those companies optimize for the output, the pollution output. And suddenly, companies, through their own purely capitalist framework, start to reduce their pollution. And then you engineer that price of carbon higher, and that results in not only revenue for the governments to fight these or to invest in these initiatives, it also causes fuel switching. So a company burning coal will now find it cheaper to burn gas, will suddenly find it cheaper to use renewable energy, and you will shift companies naturally towards greener solutions. And then thirdly, you'll see a huge amount of innovation, because now there's a price on greener processes. So suddenly, all the innovation dollars start going to ways of cutting emissions because you can monetize it. So it creates this invisible hand of capitalism, and it really is having huge impact in these markets. In the equity space, we think you need to be barbelled between two types of equities. You want to be long the solutions, so that might be the future mobility, EVs, all of the companies that are already growth style companies, but are moving us fast and creating the solutions, moving us in the right direction. Secondly, you want to be long the transition names. And these are the names which might actually be the dirtiest names. We don't tout this as an ESG investment. We tout this as an investment that is designed to monetize the climate transition, but it is also aligned with solving the problem. So we're looking at companies that might be old, value, not very clean, but of all the companies that look like this, a smaller number of them, a subset of them, are making huge shifts towards the new economy. So if you have a company that evolves, not only are they having huge impact as they evolve, but they're also being revalued as this old traditional industrial stock to a fast-growing green energy or green tech firm, and we're seeing a very healthy growth in this company. So huge equity opportunity as well. Traditional commodities don't really have a positive expected return. Energy prices go up, they pump more oil, energy prices come back down. You just have this lead and lag between supply and demand that creates commodity cycles. And that's great for diversification. It's great when there's inflation, they kind of hedge you against inflation, but there's no expected return over time. Commodities are going to be materially demanded in battery storage, solar panels, wind, the rebuilding of global grids to support all this electrification. So it's not just the lithiums and cobalts, it's also the copper and aluminum. So there is going to be a huge demand for these particular commodities over the next 5 to 10 years at levels that we can't just turn the spigot on and produce more. And so of the numbers I mentioned earlier, we talked about 227 trillion, 10 trillion of that is going into this metals basket. So we are going to materially see a repricing. So again, belong the metals that are essentially going to be the new oil, the new energy. These metals are going to be the driver of future energy and not fossil fuels. Now at Kraneshares, we've curated a suite of products to give exactly those exposures that I talked about. So our climate suite, and you can find that at Kraneshares.com, we have a suite of funds that give you access to carbon. So KRBN is our flagship, about a $600 million ETF, the largest, the first, the most liquid ETF in this space. We also offer a California and a Europe. We also have a product KSET that gives you access to the offset market. Another market, highly interesting, lots of growth potential, but perhaps more frontier style investment than the core compliance markets. We also have a selection of green equity ETFs, and you'll see, whether it be China Green Technology with K Green, we have our EV cars with a K, KARS, as well as an upcoming suite of products that will really focus on the companies that are transitioning and moving through that ESG definition from not being ESG to being ESG, because that's where the impact and that's where the returns are. And lastly, KMET, KMET, is our metals basket. And that fund is coming up on a year old and is the only basket to give you that access to pure lithium. There are lithium equity ETFs, but of course, in this deglobalizing environment, you actually want to be long the commodity, not the companies, because the companies will compete with each other, but they all need to buy the metals. This is happening, and we've already seen the big institutions already exploring the transition, they're already exploring the carbon markets. We're already seeing some of the biggest, smartest pools of capital moving into this space. How you are invested and how you have been invested is not necessarily going to work in the future. So what got you here might not get you there. We need to reconfigure our portfolios in the same way that the economy is being reconfigured, and it is happening. In the next film, we're going to deep dive into this carbon market. So most of you understand equities, most of you understand commodities, but to really get into this new asset class, we're going to do a deep dive on the mechanics, the potential upside, and how carbon fits into a traditional portfolio and where.